Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We are advantaged with this Claudia Sahm. We're thrilled that she could join us here on each and every Jobs Day, chief economist at New Century Advisors. Claudia, I guess a question to let you discuss. Maybe it's not an NBER recession, but if I've got a ginormous negative revision and an under 100,000 this month jobs report, what portion of America is now in recession?
Right. So we need to be really careful with these payroll numbers in that, it's telling us something about labor demand is slowing, right? And that piece, that contraction, that what's a recession, that's about demand falling short. We also are in a period, it's very hard to measure, but we are in a period where it is likely that the labor supply is also slowing. We've had dramatic reductions in immigration. We also have an aging workforce, right? So those two things can come together and get you lower numbers in terms of payrolls. The bad piece, the thing that like the Fed might want to react to would be the weaker labor demand. That structural piece, that supply piece, that is not something the Fed reacts to. So while these payroll numbers are pretty eye-popping, some attention, these are weaker than we thought in the revisions. Look at that unemployment rate.
Right.
It ticked up, but that is still a good, that looks like balance still.
Two-year yield was a negative 10 basis points. It's now a negative 14 basis points. To translate, folks, yields are lower, bond price is higher. The 30-year bond even is higher here, modeling out that September meeting. Claudia Sahm, if I look at the data, my amateur answer is I want to smooth out to a 3-month unemployment rate. That statistic is 35,000. I mean, the president's going to go to Jerome Powell and say, we're well under 100,000 on a 90-day jobs report. Can you say, okay, it's time to adjust? Could we have an intermeeting rate cut?
I think that is highly unlikely. Again, the unemployment rate is 4.2%.
Fair.
Right?
Yep.
The Fed, there's movements, like the Fed can't change the labor supply. They can't, like if there's structural changes, that's not their remit, that's not their tools, right? And so they're going to be watching very carefully. The unemployment rate, it did move up. If it continues to move up, if it picks up pace as it moves up, like these are real signs. The payrolls, they're telling us something, and there certainly is a risk that there's more labor demand, but this is not, no one data release would tend to, bring the Fed into intermeeting action, but this is not, just the broad brush, the top line numbers. This doesn't look like that.
Paul, in August in Michigan at Ann Arbor, there's a junior Claudia Sahm in graduate school who's going to look at the immigration overlay on this.
Yeah, I know.
That's really what's going on.
I like to see that. Claudia, Tom and I try to, kind of look at things on a rolling basis here, not get too caught up in 1 month here, 1 month there. The non-farm payroll 3-month average change, that's also notable here. It was 150,000, kind of poking along at 150,000 last month. That gets revised down to 64,000. And then this month comes in at even lower, 35,000. I don't know. That seems like something's going on out there. How do we think about that?
Right. Yes, like in smoothing through the numbers, but again, these payrolls to piece apart what is, supply and demand. And it's very hard. Like the immigration numbers, we don't have good numbers in real time, but we see border crossings have basically stopped for unauthorized immigration. And the immigration, whatever, you think about the policies, like it was an important driver of labor force growth and these job gains that we needed to be making, in years past to get the unemployment rate low. Well, it's reversed, and it's done so very suddenly. So I don't want to write this all off, and the Fed certainly wouldn't write this off. There is a sign that we've got some weakening of demand. We see that also in the GDP numbers, the consumer spending. We've seen some softening. So like it's this question of how do you pull the two pieces apart? And I mean, one rough way to kind of see where you stand is to look at how the unemployment rate is balancing out. The people looking for work, are they still at about the same rate finding that work?
Claudia, yeah. It's going to be, I can't wait to see what you publish there. Thank you so much. Claudia Sahm, New Century Advisors here on this job report. Really, just the market's moving and the 2-year yield hasn't found a bottom here. We're in 15 basis points. That's a huge move. Joining us now, and I can't think of a better time to speak to Michael Darda. Thrilled that he could join us here after Dr. Sahm. Michael Darda is with Roth Capital as well. Michael Darda, I want you to synthesize this back to classic Darda, which is the animal spirit of the country. Can we have enough inflation to keep nominal GDP okay? Or all of a sudden, is our stagflation going to become staggy?
Thanks for having me on, Tom. Look, I think if you look at the first half, because we're obviously getting some distortions in volatility in the GDP statistics, but if you average the first and second quarter, nominal GDP ran at about 4%, just a touch above 4. That's perfect. That's basically a non-inflationary setting. Once these supply side shocks dissipate, we are seeing weakness in real growth. If you look at real final sales to the private sector, just above 1% in Q2, barely 2% in Q1, and then we had a long streak of pretty close to 3% growth, in the 2 years before that. And so we're definitely slowing here, but most of it looks like it's on the real side, and that's exactly what you'd expect from an adverse supply shock. So the challenge for the Fed is just to, keep policy neutral, and that's the debate that's going on right now on the FOMC. But Claudia made the point that the unemployment rate is not lifting off. So those revisions, minus 258K for the last 2 months for payrolls, or the prior 2 months, that looks very scary and recessionary. But the reality is you will not find one NBER recession in history without the unemployment rate shooting up meaningfully, meaning at least several hundred basis points from the cyclical trough. We're basically flat from year ago levels. Same with U6. And so this is an economy where the supply side has taken a hit from tariffs and the demand side has moderated, but appropriately so.
So Michael, is it, again, there's a lot of numbers to parse through here from today, a lot of negative revisions, but as you mentioned, as Claudia mentioned, that unemployment rate is staying right at 4.2%. And is that where you think the Fed will keep its focus, that number?
I think so. I mean, that's essentially what Fed Chair Powell discussed this week in terms of the economy being in balance, supply and demand being in balance. I mean, look, at the margin, I think these numbers definitely lead the Fed to lower policy rates. The question is, what is the timing and the magnitude? Futures markets are priced for about 90 basis points of cuts over the next 12 months. But markets have anticipated sooner and deeper cuts than what the Fed has been willing to deliver over the course of the last few years. So that's not new. I mean, the question here is, do things really fall off from here unless the Fed gets moving? And risk markets, despite today's action, are pretty optimistic that that we'll hang in there.
Michael Darda, when you look at this jobs, and if we're under 100,000 as a glide path, we get the emotion of a negative statistic. We don't have that. What will the nominal 10-year yield do?
Well, we're right in a range here, Tom, right? I mean, we came into the year pushing 4.8%, and we obviously slumped below 4 for like a day when we had the risk-off event when Trump first announced the reciprocal tariffs. And now we're kind of, right in that range. I mean, it's interesting because reflectively, people start talking about fiscal deficits every time rates move up, but then when they come down, no one attributes that to an improving fiscal outlook. So perhaps something else is driving the rate structure here. And I think what's driving it is simply risk on and risk off, the contours of the business cycle in Fed policy rate expectations moving around, which is obviously hitched to both of those. And so, the 10-year yield here, to me, I mean, we're kind of neutral on bonds here. If we're closer to 5% bullish, sub 4%, then I think you want to be more cautious.
So, Michael, I'm starting to see in my inbox and in social kind of a narrative that history may be repeating itself. Last year, the Fed erred by not cutting in July, so they did a catch-up cut at their next meeting. Is that something that might be brewing again this year?
I mean, Paul, it's possible, but I think you'd need ongoing data deterioration and perhaps some kind of a risk-off event. The Fed did get going with a 50 basis point cut, last year, second half of the year, they cut 100 basis points. But then what happened? They stopped. The labor market stabilized. So I kind of think all in, they're going to restart in a more gradual manner. September very well is still in play here. If you look at the labor market diffusion index, I just brought it up on my Bloomberg screen here for you guys. We're at 46.8 as of this July. So that's actually a little bit below where we were last summer, which along with the rising unemployment rate, which we don't have this time, really kicked off alarm bells that the Fed was falling behind the curve. You also had lower bond market inflation expectations going into the early fall last year than what we have today. And that could be a consequence of this hectoring from the White House, which is backfiring, in my opinion. So
let's talk about that, Michael. And this is the history of Michael Darda and all that he has at Wisconsin. To me, and what a privilege yesterday, Michael Darda, to talk to Richard Clarendon and Lyle Brainerd back to back about the modern trend that if we cut rates or raise rates, we're establishing a new vector. Why can't the chairman come out and say, back to Volcker, back to Burns, we're going to do a one-off 25 beep cut and reassess? To me, that's common sense, but it pushes against all of modern academic theory, doesn't it?
Yeah, I mean, I think, Tom, it comes down to, what have the markets priced in here? So the markets have priced in 91 basis points over the next 12 months. So does the FOMC guide markets for more than that or less than that? Right now, I mean, I think you've got quite a bit of division on the committee. We did get 2 dissents. That's the first time 2 Fed governors dissented.
They look like geniuses this morning.
Since 1993, right. But I think the focus has to be on price stability. I mean, obviously, the Fed wants to preserve the business cycle, but inflation's still above target. And if the Fed is going to be harangued and cajoled into cutting rates when it's perhaps inappropriate to do so, if inflation expectations go up, then long-term interest rates go up, not down. So if the president's concerned about debt financing costs, let the Fed do its job. Let's return inflation to target, and price stability is the number one way that you're going to have moderate market interest rates. The other way is get the fiscal house in order, and Washington, D.C. has
good luck with that.
Base planted in that regard.
Michael, thank you so much. Michael Darda, Roth Capital. They're really looking forward to his research note published into the weekend. Kristina Campmany waiting for her first gray hair. She may get it with the way the 2-year yield's moving today with Invesco. Kristina Campmany here before I believe Steph Roth's going to join us. What does it mean for adults in the bond business when you see, this is CFA level 4, you see a ginormous 2-year yield move?
Look, I mean, we're getting a big steepening of the curve today. And I think the market has vacillated this year between, is the Fed more concerned with growth? Are they more concerned with inflation? Which is it? And a lot of the economic weakness we've seen all year has really been soft data. And today is really the first signs that you're seeing some real hard data that's weakening. And it's not the 73 number, it's that negative revision number, which is meaningful.
We nailed that.
Yeah.
We nailed it. Tucker nailed it.
So, Kristina, how do you think the Fed's going to view this data? It's almost like, boy, if they had known this data yesterday, would they have done something different. How do you think they're going to view this data here? Is this a one blip, or is this something different?
Was that brilliant? Would they have done something different?
I don't know that they would have done something different. And I think we've said, really, even coming into the summer, that they have the calendar on their side in terms of the gap to the September meeting with two payroll reports, two CPI reports. You're really supposed to see a lot of these inflationary numbers come through from the tariff shocks, which has all been delayed. And a lot of participants in the market have said, well, they haven't come through yet, so we just don't have to be worried about inflation. That's not our camp. I think that there are still risks. The Fed and Powell's statements in the presser, I think, very clearly tells you he's concerned about not even just first order effects that haven't shown up, but second order. So there's a lot of time. It certainly gives nods to the dissents that we had this week that are talking for preemptive cuts, or Tom, what you were talking about earlier of like, why don't we just ease because we know we're restrictive and like give ourselves some wiggle room? But that hasn't been where the Fed's been anchored, even though a lot of us think maybe that's what they should be doing.
Paul, continue the conversation. We've got a beautiful 3-month moving average chart. In October of 2023, when the market lifted, it was a 200,000 every month, 3 months moving average. We're now down to 35,000. In defense of the president and Secretary Besson, that's a vector.
Yeah, it is. It's certainly something to pay attention to. And again, we're seeing in the short end of the curve, the 2-year yield is now off 17 basis points. We have a 50 basis point steepening in the yield curve. What does that tell you?
Look, in a lot of ways, the curve we think should be steeper still, even with this move today. And coming into this week, really in the last month, you've seen kind of this retest of what has been the thesis this year. You've seen a big flattening in the last week. You've seen a big correction in foreign exchange with the dollar stronger. And now we're kind of turning these back on our heels. But with where we are in a cycle, the curve shouldn't be flat. And we've gotten in cash space almost down to back 210s, close to a flat level. So we need to re-steepen that out. And it tells you that even if the Fed is not easing to yesterday or tomorrow, that is in the pipeline, that's in the trajectory. And the long end should still be at where it is anchored or at higher levels because the inflationary risks remain out there.
Have you ever been called a bond vigilante?
No.
Are the bond vigilantes out today telling the Fed what to do?
I don't know if they are. I don't know if the bond vigilantes of old kind of remain in the same sense. We don't have these. I think there's a lot of fear of like the Liz Truss moments in these like dramatic sell-offs. Really, today's move is a front-end correction, and I think on that. But is that a narrative in the market about what are fiscal pressures? What are we doing big picture of like controlling inflation and supply and all these things?
We're bringing in $300 billion tariff revenue to pay for a big bill for a tax cut. I'll be political and say it's spread out across the deciles. And some people would say it's skewed for the fancy people like Paul Sweeney. Okay, fine. I'm looking at the screen and I got a 90-day moving average of non-farm payrolls that, Paul, not that long ago would have been, is the economist Bart Simpson would say, a total cow.
Exactly.
That's the bottom line.
This is what people have been waiting for really at least the last
We're
9
here.
months, if not 2 years, right? Since 22, when we were looking for this rolling recession is imminent.
So credit, what do you do with credit here? I mean, it sounds like maybe I don't want to take too much credit risk here.
Yeah. So we have been a little bit more cautious on credit, and that's been a kind of a harder call because credit remains exceptionally tight, keeps grinding. You're in a slow supply period over the summer. So we kind of have bits and pieces of credit, but where we're probably most comfortable owning credit is higher quality front end paper. And then there are some things kind of globally that look interesting too. In Europe, some credit, whatnot.
It's Friday. We're at the beach. Does a 5-year CD look good right now?
I still think it looks pretty decent.
Yeah.
Grab the coupon.
Yeah. Why not?
Okay.
I don't know, 2-year treasuries now, but I mean, that's a big sell-off in the 2-year.
Okay. What are you going to do when you get back? What are you going to do when you get back to the office? I mean,
are you going to buy or are you selling?
Well, no, but you got price up, yield down in the 2-year.
Yeah.
Do you lighten up on that? Is it like a stock where you
So we've kind of shifted into more steepeners with this and kind of say, like, what are the tacticals? Because it's again, what's your big picture thesis? I don't think that those have changed, right? Like, we believe in a weaker dollar. We believe that the curve should be steeper, but we keep vacillating of what the Fed's pricing. And I think coming into this, the front end looks like it was stretched.
Kristina, thank you so much. Kristina Campmany here, and a huge day for Invesco and her bonds as well.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Here's what you need to focus on. Clarida and Brainerd, they don't listen to us. They listen to Ernie Tedeschi. Joining us now from the Budget Lab at Yale, I should say, Ernie Tedeschi, who drives a lot of their mathematics. Ernie, I don't want to give away the publication of your report, but you were kind enough to say you've done an all-nighter trying to get out in front of a new tariff calculation from the president. Can you state that your 18% maybe adjusted for consumption substitution, 17% tariff is going to go up?
So actually, when you look at the list that came out last night, some of the tariffs went up. Some of them went down from what was threatened before. So like Bangladesh, for example, went from 35% to 20%. Thailand went from 36% to 19%. So it was kind of a mix. When you add everything together, we had been at 18.2%. Now we're at 18.3% for the average effective tariff rate. And the other big one is that Mexico got a 90-day stay.
Yeah.
So they were supposed to go up to 30%. They're now at 20%. That's another big factor in this too. So really, like versus 48 hours ago, this list didn't make a giant difference.
It's, folks, I can't say enough about the importance of what they're doing in terms of the graphical representation. Ernie, I'll get to Mexico in a moment. Paul's got a bunch of questions too. You have I take great offense to our analysis that we're back to Smoot-Hawley 33 and 34. If you look at the Tedeschi horizontal line, we're back to 1918. We're back to 1862. Indeed, we are back to 1799. Nice. What does that history mean for 2026 in America?
I mean, look, like those were very different times back then. I think number one, it means, I agree with the administration. We're going to raise a substantial amount of revenue from these tariffs.
And Brainerd said that yesterday. Lyle was all over that yesterday.
Look, and one should not understate how important that is. We have an unsustainable fiscal trajectory. Well, we project $3 trillion over the next 10 years. But look, we're also seeing evidence of this already in consumer pass-through. Durable PCE, that was part of the PCE report that came out yesterday, accelerated the most over 6 months that it has since 1987, other than the depths of the pandemic. So, the idea that we're going to somehow dodge a bullet and get through this scot-free, I think is already empirically wrong.
So, Ernie, that's a key point, that $3 trillion over 10 years that the U.S. government's going to raise. That's not being paid by China, by Mexico, by the EU. That's being paid by the American economy. And I don't know where it comes from, the consumer, the importer, the retailer. Talk to us about it on a household basis. How much do you think consumers are going to pay on per household basis?
Yeah, this is a very, very important question. So first of all, on your first point, if foreigners were paying this tariff, we would expect import prices to decline. Import prices have not declined. If anything, they've ticked up a little. So on average, they're probably not shouldering much of all of this. We think that right now, consumers are paying about 70% of the tariff, so that's the pass-through right now. And we think that that's ticking up over time. It's still early. Ultimately, if these tariffs today stayed in effect in perpetuity, that would be $2,400 per household per year after, say 2 years of phase-in, pinching families at the bottom much more than at the top.
And that's after tax, right? That's after tax.
That's right.
So you're talking,
right, yeah.
Somebody popping 60, 70,000 a year, figure out the rent. Forget about the idiocy in New York City. I mean, Ernie's living large up in New Haven.
Yep.
But the answer is $2,400 after tax. That hammers the bottom three deciles. Folks, I can say this again. Ernie Tedeschi with us before we go to Trade Minister Greer here with John Farrow. The Budget Lab at Yale, it's free. You go out, it's a website. It's spectacular, whatever your politics, and with all sorts of charts. Ernie Tedeschi, Mexico, avocados, tomatoes, broccoli. The Budget Lab at Yale. Food prices rise 3.4%. and stay 2.9% higher forever. Fresh produce from Mexico, I'm ad-libbing, is initially 7% up and then stabilizes at 3.6% higher. Is that why we delayed from Mexico? As they explained to President Trump, the price of tomatoes?
So here's the good news about these tariffs is that they exempt products that are USMCA compliant from Canada and Mexico. It's complicated, but like basically you can think of it that if your product is actually made substantially in Mexico and Canada, then it is exempt from the tariffs. Fresh produce is, 80% of the fresh produce that we get, 90% of the fresh produce from Mexico right now is USMCA compliant. So it's not Mexican imports that are driving the food price increases from these tariffs. It's the non-Canada and Mexico countries. So coffee from Brazil, bananas from Central America. That's what's getting hit by these tariffs right now.
Are you surprised, Ernie, that how it's played out with Canada being such a big trading partner of the U.S., that the discussions with Canada and Mexico seem to be quite different?
It does surprise me. On the other hand, their reactions have been quite different. You see no retaliation from Mexico to our tariffs so far, whereas Canada is the only country other than China that has levied counter tariffs, and to their detriment, I might. I mean, the politics of doing that are completely understandable, but that just heightens the economic damage to Canada and to the United States from these tariffs. So it doesn't surprise me that our counter reaction is different.
So Mr. Greer's going to be on here in a moment. If you were sitting in a room this morning with Mr. Greer and it's the Secretary of Commerce, the Secretary of Treasury, they pop in to see Dr. Tedeschi. What's a single thing you would say to the Secretary of Treasury now as he tries to advise a president who didn't take Micro 101?
I would say two things. One is a question, one is a comment. The question would be, what is the strategic goal here? Why are we tariffing things like bananas and coffee again?
Do you agree with Vice Chair Brainerd that the strategic goal is to raise revenue to pay for the other piece of Budget Lab analysis, that big bill?
I think that's a secondary goal. I think that this administration is true believers in tariffs. They think manufacturing and jobs will come back. But I would say two things. One, why then are we tariffing things that will never come back, like bananas and coffee? And then the second thing I would say is there can we work together to find a better way to raise this same amount of revenue that doesn't hit either lower income households or investment as much as tariffs do?
So typically, Ernie, how should tariffs be used? How have they been used in the past successfully? And is that policy being, followed today?
Look, this is another area where I agree with the administration. There are unfair trade practices out there against the United States, and tariffs are ammunition in resolving those disputes. That has absolutely been the case in the past. They have not, since at least the 1930s, been used for substantial revenue. And similar to that, we haven't, levied them broadly. If we've used them, it's been on very specific items, not because we don't like those items or those countries, but literally to try to get those countries to the table to resolve trade disputes. So this is very different than the way we've used tariffs in the past.
Ernie, September 5th, 1901. I know you read this in Doug Irwin's Against the Tides. September 5, 1901, McKinley does a recant of his trade certitude. He does this the day before his assassination. Do you frame out here that if the president is, whatever your politics, folks, I don't care. If you frame out he's overcome by events like inflation. Could we have a Trump recant where he gets us back to Uruguay, where he gets us back to GATT?
It's really hard for me to see that. Number one, they are true believers. Number two, now we're stuck with this $3 trillion in revenue, which again, I would emphasize, like that part of it is a good thing and helpful. I think that that's going to hinder any future administration, Republican or Democratic, whether, if they don't like the tariffs, it's going to be hard for them to replace them, right? Because you're going to have status quo bias. And, I can sit at a spreadsheet and come up with all sorts of great theoretical alternatives all day long, but most of those alternatives require Congress to take a vote,
right?
Which is going to make it hard to replace the revenue that's already in place.
Very quickly, Ernie, we have judiciary action over the last 2 days in an appellate court listening to the legality of the president's action. Could that be a bombshell where they say to President Trump, you can't do this?
I would emphasize I am not nearly as useful as a lawyer.
We know
but
that.
If we did, but if we did get a decision like that, I think it would be a bombshell. It would not be the end, though. There are other legal authorities that at least temporarily they could use to re-raise tariffs.
The website of the year for Bloomberg surveillance, without question, the Budget Lab at Yale with the leadership of Ernie Tedeschi, just been absolutely spectacular.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Anurag Rana joins us, Senior Technology Analyst for Bloomberg Intelligence. Let me go to where Mark Gurman is this morning, Anurag. There seems to be a haste to just do something in artificial intelligence. After what we saw from Apple yesterday, is M&A part of Mr. Cook's future?
I mean, he talked about it last night on the call, and frankly speaking, he said, they will look at deals, but, I'm, to be honest, not so keen on them buying a very large company for a very large amount, because I would rather them partner with multiple vendors to use different models, because we are still in very early stages of figuring out which models will eventually be used for what function. So I'm more in the partnership camp rather than buying camp.
So would you see them doing partnerships with Google on Gemini? And on Perplexity out of Berkeley.
Tom, I really hope so, because there's a lot of money involved in that search deal. So if they were to do a revised deal, including Gemini models and some kind of search agreement, and then get paid for it, I think that's in the best interest of Apple, both shareholders and employees.
Anurag, I saw China. They called out China as a source of growth there. That's been a big headwind, or a big question mark, I think, for a lot of investors, how Apple would perform in China, given all the crosswinds there. What did you learn last night about Apple in China?
So two things happened in China, and that's something we discussed yesterday morning. One is the pull forward of demand across the world because of tariff related. You could say people are fear that the prices are going to go up, so they bought it. The second thing that happened specifically in China is some of Apple products, some of their phones were eligible for discounts through the carriers. This is something that doesn't happen, hasn't happened before. So those were the two factors that helped them at least, get over the positive territory after some time.
Anurag, probably I would say if I'm the average investor, I guess my biggest question about Apple is, to what extent will they play and how will they play in the world of AI? Did we learn anything more last night? Did Tim Cook have anything else to really share?
I think he repeated a lot what he repeated back in June in the Worldwide Developer Conference about Apple Intelligence and embedding more throughout the ecosystem and the operating system. But at the end of the day, Siri is most important, because that's the voice command where you ask for things, and they are a bit behind on that. And that's where the partnerships may come in and help them accelerate with that particular function and then get it improved quite a bit.
Anurag, you published with Andrew Gerard this morning. He thinks I don't read his research.
Oh, we read his research.
I do. Anurag, after I was done looking at the Chicago Cubs non-trading deadline, I looked at your piece on Gen AI to lift Microsoft over 2026 consensus. We talked about this yesterday, but now that we've got Microsoft, Meta, Amazon, Apple in all, do you have a better clarity about late 26 into 2027?
Yeah, I think from a growth rate point of view, Microsoft will still do better than all the others, largely because of their relationship with OpenAI. So remember one thing, every time you and I spend more time on ChatGPT, a lot of that processing is done by Microsoft. That's really their biggest advantage right now. And that's where, Amazon shareholders are unhappy about it because they didn't see that lift in revenue growth as what Microsoft saw or what Google saw.
So how do the upstarts stay in the game? I'll pick on Perplexity just because Joe Weisenthal told me to, but how does someone like Perplexity compete with these giants?
See, Perplexity is fine in that case because it's competing directly with OpenAI and other, applications that are AI-based applications. So it is trying to basically tell, users like myself that don't go to ChatGPT, start using my application. It's better. It's really in that realm they fight. Whether it comes to somebody like an Amazon or Microsoft or Google, the question is, who is hosting their app on their cloud platform? And whichever, if you, let's say for the sake of discussion, if Perplexity is hosted on one of these platforms and their user count goes up, they make more money on the back end, not so much on the front end.
Amazon also reported last night, Anurag, after the close. It looks like the stock's trading down about 7-8% here, weaker than expected operating income, and maybe trailing the sales growth ahead of its cloud rivals here. Help us think about Amazon right here.
Yeah, again, there are two factors of it. They do not have a ChatGPT-like app that runs on their platform, which is why they don't get that consumer lift that Microsoft is getting. The second thing is their run rate is very high. According to last night's number, they're running at somewhere around $120 billion in revenue compared to Microsoft's 75 and Google's 50. So there is a difference in growth rates. I mean, it's just pretty logical. But, that's what I said. If you were to strip out Microsoft's AI contribution, they would be running in their 20s also. So I think the most people do not, I think the bigger disappointment is both the other cloud vendors beat by a big amount and these guys just met. And that the reason for that is the lack of a consumer app. Now, I think over time, Amazon will come back and showcase that they will also get AI workloads, but they will come more from the enterprise side, not so much from the consumer side.
So very quickly here, and I think this can really help the dummies like me and Anurag. How are each of their audiences or potential audiences of AI different? Who's Amazon going after? Who's Microsoft going after? Who's Google and others going after?
Yeah, all of them are pretty much going after the same kind of customer, but Amazon is pretty much dedicated to large enterprises. So let's say if JP Morgan is experimenting right now to creating an app internally or a chatbot internally that has AI, over time, the usage of that will grow and that would help AWS. As I said, the case with Microsoft is because of their relationship with OpenAI, ChatGPT has gone from, arguably somewhere around, 700 million users daily. And the amount of time you're using on the app is quite big every day. So Microsoft is making more money off of it. It's more a timing issue than so much that one is better than the other.
Anurag, thank you so much. Anurag Rana, which is real expertise there with Bloomberg Intelligence.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Sebastien Page joins us from Rowe Price. His book on leadership out. I'll get that out on Twitter and on LinkedIn here in a bit. Sebastien, thanks for joining us today. The heritage of Rowe Price, back to my ute, is you guys were out front on technology and growth. Rowe Price on the reaffirmation of this technology juggernaut in Mag 7.
We absolutely love to research technology, understand technology, capture the trends. Tom, I hear the same words from different analysts and portfolio managers on our platform these days about AI. Same expression. They're all saying it's real.
Mm-hmm. Yep.
And if you look at the projections for spending on AI for the next 12 months, it's not decelerating. It's accelerating. It's expected to go up by 80% globally. So here we are. It's not just about spending. It's also about productivity gains.
So Sebastien, does that say we continue to just focus on the Mag 7 or just some of the big tech names, or are you trying to find value outside of that group that's worked so well?
That's such an important question because everything I just said is basically the consensus. Yep. Stocks are up 30% in 3.5 months. The price earnings ratio is at 22, and the market is more concentrated than pretty much any time in history. So you're going into earnings season. It's interesting. I'm listening to Bloomberg Surveillance. Everybody was saying, we're going to get positive surprises. We're going to get positive surprises. And I get a little bit philosophical here, and I ask, is it still a surprise if everybody expects a surprise?
Yep.
Probably not. And you're seeing that now. So, long way of saying we're long diversification in our portfolios. You should own the growth stocks, but from an asset allocation top-down perspective, we're long diversification, and we're getting most of it right now from international value, small and mid caps.
Really? So we saw earlier in the year when there was some of this volatility around Liberation Day and the shock of tariffs, investors were taking money out of the U.S., out of the dollar, out of U.S. stocks, out of bonds, and putting it elsewhere, the rest of the world, including European equities in a big way, who have been outperforming. Is that still the call there, or is that just a short-term trade?
You know, from a macro perspective, it's counterintuitive, but some of this is jolting Europe in particular into spending, fiscal, infrastructure. We expect the debt to GDP in Germany to go up by 20% over the next 10 years. So that could be, look, I still believe long-term in the exceptionalism and the dynamism of the U.S. economy, but right now you have macro momentum.
Right. Sebastien Page with his folks. The VIX blows out to 19.10 over two big figures out with the tensions of the morning. Okay, I get Windsor, Ontario, and the stereotype of an auto industry in Canada flat on its back. You've lived, I mean, did you see Jean Beliveau at the Forum?
I did not. I did not, yeah.
I mean, you know, you lived Quebec. Fine. What do these tariffs mean for the rest of Canada? Not Windsor, but for Resource Canada, what Christian Friedland used to talk about, plywood and sexy things like that. What's it mean?
It matters a lot. It probably matters more than counterintuitively, again, for the U.S. In the U.S., goods subject to tariffs represent only 9% of GDP. So I got to say, Tom, I'm both a Canadian citizen and a U.S. citizen. So I have a view that's, I would say, neutral here. But generally speaking, it looks like Canada just wants to get a better deal, and that's why they're holding out.
Should others hold out? I mean, is that what T. Rowe Price would say is it is a new tariff war, as Yale Budget Lab says we're back to 1933? Should the other countries push?
Look, you know, on days like today, it sounds like, it feels like tariffs are driving the entire U.S. economy. Again, goods subject to tariffs represent 9% of GDP. There are knock-on and implied effects, but you have many other factors that, in my mind, matter more.
Right.
Fiscal spending, the strength of the consumer, the corporate earnings, these all look pretty good.
Well, one more question. Your book, Beyond Diversification, is absolutely phenomenal. Let's go there right now. How should our listeners and viewers diversify given the global trauma that we're in right now?
Yeah, you know, Tom, I don't know if you notice, but when I go to the dentist, my dentist always wants investment advice. I guess they have a little bit of money. The dentists are well paid, and, oh, you're in the investment business, what should you do? But you have 2 seconds to say something. I always say the most trite thing to say, which is stay invested, stay diversified. And I have in my notes for you all today, the headline is Be Boring. We actually have a lot of our tactical positions, not all, that are neutral. We are long diversification. Sometimes it's painful when markets become more and more concentrated, but I think that's the right thing to do right now.
Sebastien Page, thank you so much for getting us started this morning. He's with T. Rowe Price.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We finished strong with Anna Wong, who saw this coming. Dr. Wong, before we get the market open, Kaylee Cox over at Ritholtz identifies that the labor force has declined for the 3rd straight month. It's the first time that's happened since 2011. You nailed this with your historic discussion of birth-death models in that. Is the vector in place to get to a negative non-farm payrolls?
I think today's very weak payrolls report and the massive downward revision suggests that the negative payroll is probably with us right now. So with today's reading and our read that the overstatement per month is roughly between 80,000 to 100,000, that means today's print means slightly negative payrolls. So I think today's print will bring back the recession narrative because it is very, very weak.
Claudia Sahm didn't want to go there.
No. No.
Dr. Wong, it's the way she rolls.
Anna, how do you think that the Fed is going to view this data point? Again, it's just one data point. We heard that from President Hammack of the Cleveland Fed. How do you guys think the Fed will view this?
Yeah, so President Beth Hammack is basically the most hawkish individual in the FOMC committee,
Really?
according to our spectrometer. Yes, and in terms of this payroll, however, it really vindicated Chris Waller's position. And in fact, Chris Waller issued a dissent note today, and it basically confirmed his read of the labor market as you have to read beneath the headlines and go into details and think about the revisions, because even today's revisions are larger than what I would have expected, and I'm already on the high side in the market. So so I think Chris Waller will gain a lot of clout within the FOMC, and we will likely be seeing an earlier rate cut this year.
Dr. Wong, I understand people like you were at Chicago and you're trained to be measured, get on a trend. We don't want to cut rates until we really have a trend in place. Isn't it a perfect time to just do a 25 beep cut and reassess?
I think the policy rule would say yes, they should be cutting now, but at the same time, I think today's very weak payrolls report and the massive downward revision suggests that the negative payroll is probably with us right now. So with today's reading and our read that the overstatement per month is roughly between 80,000 to 100,000, that means today's print means slightly negative payrolls. So I think today's print will bring back the recession narrative because it is very, very weak.
Claudia Sahm didn't want to go there.
No. No.
Dr. Wong, it's the way she rolls.
Anna, how do you think that the Fed is going to view this data point? Again, it's just one data point. We heard that from President Hammack of the Cleveland Fed. How do you guys think the Fed will view this?
Yeah, so President Beth Hammack is basically the most hawkish individual in the FOMC committee, according to our spectrometer. Yes, and in terms of this payroll, however, it really vindicated Chris Waller's position. And in fact, Chris Waller issued a dissent note today, and it basically confirmed his read of the labor market as you have to read beneath the headlines and go into details and think about the revisions, because even today's revisions are larger than what I would have expected, and I'm already on the high side in the market. So so I think Chris Waller will gain a lot of clout within the FOMC, and we will likely be seeing an earlier rate cut this year.
Anna, stay with us. Please, please, please stay with us. Anna Wong with us at Bloomberg Economics. We're going to get the markets open and come back to Dr. Wong. What you need to know, futures deteriorated. They came back actually off the report. They're now negative 64 on SPX. The VIX out 2.20 points for global Wall Street, and we welcome you worldwide. Good morning in the Friday Pacific evening. It's real simple. You have a 2-year U.S. yield now, a full 20 basis points yield down, price up on the 2-year yield. As we get the markets open, our John Tucker.
All right, and the opening bell report being brought to you by Oppenheimer. Oppenheimer focuses the power of their thinking on you, creating customized plans to help achieve your goals. Put the power of Oppenheimer thinking into your investing, wealth management, capital markets, investment banking. Right out of the gate, we are lower. S&P 500 down 1%, 62 points lower, 62.78 on the index. The Dow Jones Industrial Average down 378 points. The NASDAQ 100 right now 275 points lower. That is down 1.2%. Shares of Amazon helping lead the declines right now, 7% lower. And shares of Apple up in the early going. They are up right now 1.5%. That is your opening bell report, Paul and Tom.
Thanks so much, John. So much good work coming out. Ernie Tedeschi, thank you so much for joining us from the Budget Lab at Yale in the last 2 hours. Here's Tedeschi reporting in as we go to Anna Wong here, again down -400 on a market opening. Tedeschi, the 253,000 negative 2-month downward revision is the largest since at least 1979, other than the COVID noise. Dr. Wong, I understand people like you were at Chicago and you're trained to be measured, get on a trend. We don't want to cut rates until we really have a trend in place. Isn't it a perfect time to just do a 25 beep cut and reassess?
I think the policy rule would say yes, they should be cutting now. But at the same time, I think what the Fed is thinking about is that inflation might be surging in the next couple of months. And so in my team, we are scraping online prices to get a real-time look at how prices are doing. And what we are seeing is actually a mixture. We see some goods that has raised prices a lot in the past 3 months already, feeling like maybe they could not pass through all the tariff to the consumer because they're seeing a drop in demand. So those things are things like sporting equipment, because we really have seen an audio equipment, because those two categories have seen, well, the firms in those sectors thought they could raise the price by over 10% and consumers would just take it. But turns out people are just not as happy about that. But on the other hand, we're starting to see toys prices going up. Men's furnishings, apparels, and suits going up. Women's suits going up.
It's bow ties, Anna. They're killing me.
I think
it's killing me. The bow ties.
I think
Anna, let me do this. I want to get this in.
How much did it cost?
Yeah, this is Neil Darda here. The prime age employment rate has declined 0.5% over the last year. This is not good, and it's a reminder that unemployment being low is not necessarily a fair representation of what's going on in the job market. Darda really pushing against it. He's looking at non-farm payrolls. Others are looking at the comfort of 4.2%.
Anna Wong, Callie Cox, Ritholtz Wealth Management, is out on social saying the labor force declined for the third straight month, the first time that's happened since 2011. What's going on there with the workforce?
Yeah, so the decline in the last 2 months, and I think we haven't looked at the details for this month, but I think the trend in the last 3 months is that it's the youth, the people who are graduating out of college, the people who are in their early 20s that are driving this decline in labor force. And I think, I know the narrative out there is that it's immigration, it's the undocumented, but actually I think the dominant thing is the youth, and we need to figure out what's the story there. There's some signs that it's related to AI, and that with firms trying to replacing a lot of entry jobs, white collar entry jobs with AI, there's just less need for, interns or younger. It's just harder out there for people graduating out of college.
We're calling interns this year junior analysts. I don't know why, but that's what HR told me. Anna Wong, thank you. Really leading the nation on careful analysis of our labor economy. She's with Bloomberg Economics.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.